Good evening, all. Today we are going to be discussing on pensions and gratuity. Where we are going to be discussing on the provisions of the 1999 constitutional provision regarding to pension and gratuity. We'll be looking at the outline objectives of Pension Reform Act 2014. We identify the categories of people that are exempted from Pension Reform Act 2014. We will discuss the powers and functions of the key pension administration institutions. Then we'll look at IPSAS 39, which is on employees' benefits. Under the 1999 Constitution provision, what are the treatments of pension and gratuity? This pension and gratuity, these are levy, these are fee, these are provisions made to employees after attaining the age of retirement. Section 173, subsection 3 of the 1999 Constitution says that pension shall be reviewed every 5 years or together with any federal civil service salary reviews, whichever is earlier. That is, every five years, there will be a review to pensions, whereby all the pensioners will have their benefits at the end of their service period till they attain the old age or till when they eventually leave the earth. Section 173, subsection 4 of the Constitution stipulates that pensions in respect of service in the public service of the Federation shall not be taxed. So any pension will not be subject to tax according to section 173, subsection 4 of the 1999 Constitution. Then according to section 84, subsection 5 of the same 1999 Constitution, any person who has held office as president or vice president shall be entitled to pension for life at a rate equivalent to the annual salary of the incumbent president or vice president, provided that such a person was not removed from office by the process of impeachment or for any breach of provisions of the Constitution. So here, a pensioner will be entitled to life pension. The president and the vice president, equivalent to the annual salary of the incumbent president or vice president. So imagine, as we're having past presidents up till present, those that are still alive, they'll be collecting pension in form of annual salary as that of the incumbent president or vice president. And this will be for life. We also have section 84, subsection 6 of the Constitution that states any pension granted by virtue of subsection 5 of this section shall beach upon the Consolidated Revenue Fund of the Federation. Then the Pension Reform Act of 2014. This act repeals the Pension Reform Act of 2004, and the act continues to govern and regulate the administration of uniform contributory pension scheme for both the public and the private sectors in Nigeria. So the provision of Pension Reform Act 2014 shall apply to any employment in the public service of the Federation, the public service of the Federal Capital Territory, the public service of the state government, public service of the local government council, and the private sector. So the 2014 Reform Act made it mandatory to all these personnel to be registered under the Pension Reform Act that mandates it to all employees to be under one or the other scheme of pension. That is any employment in public service, that is for the Federation, for Federal Capital Territory, public service to the states, public service to the local government, and all private sector. In the case of the private sector, the scheme shall apply to employees who are in the employment of an organization in which there are 15 or more employees. The 2014 Reform Act made it mandatory for any private sector that are having minimum of 15 employees or more than 15 employees to register under the scheme, to make it mandatory to all their employees to be on . Hello, Mrs. Aboderi. Can you hear me? Others, please, can you hear me?
I can hear you, sir.
Oh, but she said she can't.
I
Who
can
else?
hear.
Oh, I believe it should be our network.
So your network is very poor. Your voice is cracking.
It is okay around here.
It's clear for
Who
me.
else cannot hear me?
I can hear clear.
Hello.
Hi. Hello, sir.
Hello, please, can you hear me?
Yes, I can hear you clear.
I can hear you.
I can hear you.
Still on Pension Reform Act of 2014, the Act stipulates that all employees should be registered under the pension scheme. And what are the categories of employee? Employee under the federal government, state public servants, local government servants, and private sector. And the same Reform Act also stipulates that in case of private sector, the scheme shall apply to employees who are in the employment of an organization in which there are 15 or more employees. That is, if you're having less than 15, they can't be able to register for pension and gratuity. We have employees of organizations with less than 3 employees, as well as self-employed person, shall be entitled to participate under the scheme in accordance with the guidelines issued by the Commission. So here, there will still be some threshold to be able to allow some employees to register under the scheme. So we can find out that there are some employees that were denied to register for pension, and this may be due to the limited employee in that organization. So if you're having any employee in any organization that is finding it difficult to join the Pension Reform Act, a scheme, to join any of the scheme, that means it's because of their organizational employee base. The objective of the new Pension Reform Act is that establish a uniform set of rules, regulations, and standards for the administration and payment of retirement benefits for the public service of the Federation, the public service of the Federal Capital Territory, public service of state governments, public service of local government council, and the private sector. That is to set up a uniform standard, rules, and regulation And as we can see now, the standard has changed from the old Reform Act, whereby there are means to calculate what are the pensions that are attributable to employees after their retiring age. That has not been in place anymore because of the new reform on the Pension Reform Act. Make provision for the smooth operation of the contributory pension scheme. You ensure that every person who works in either the public service of the Federation, the public service of the Federation, Federal Capital Territory, public service of the state government, public service of the local government council, and the private sector receives its retirement benefits as and when due. Here, there won't be any discrepancy between the pensioner and the government or the private employees by not having their retirement benefits as at when due. And there won't be any need of all the pensioners to be queuing in the bank by expecting some officer to release their retirement benefits, whereby they will still postpone by saying the pensioners should come back in the next 3 or 4 days before they can get their retirement benefits. So the Reform Act make it easier for all retiring officers to get their retirement benefits as at when due. Assist improvident individuals by ensuring that they save in order to cater for their livelihood during the old age. There are some categories of people that look at, why will government be removing from my salary, or why will my employee be removing some certain percentage from my salary, and they are telling me that they are saving it for pension purpose. How am I sure? How is it certain that I will have to benefit this scheme that reduction has been made on my salary? So this is part of the objective that this scheme is aiming at, so that at the old age, all employees will have savings in order to cater for some other activities or expenses that will be expected of them, and to make life easy. The rate of contributions to the scheme. The contribution for any employed to which this act applies shall be made in the following rates relating to its monthly emoluments. A minimum of 10% by the employer and a minimum of 8% by the employee. This is the rate at which pension is being saved into the pension fund account. The employer will have to pay 10% of the basic salary of the employee, while the employee will also make 8% to that plan. So if any organization that is having more than 15 employees and they are unable to register, or they are neglecting the registration of pension, they are short paying the employees by not giving them their entitlement of this pension, because 10% will be paid by the employer, while the employee himself or herself will be paying 8% of their basic salary into the pension accounts, pension fund accounts. This deduction should be made from the worker's salary at source, while government contributions shall be at first charge on the Consolidated Revenue Fund of the Federation. So on monthly basis, the 8% will be deducted from the employee salary at source before the next payment of salary will be made to individual employee, while the employer will be contributing 10% to that account, and is for the benefit of the employee after retiring age. The rate of contribution may, upon agreement between any employer and employee, be revised upward from time to time, and the Commission shall be notified of such revision. It is also allowable under this scheme if the employee can make more than 10%, or if the employer can make a contribution of more than 10%, and the employee wants to be making more than 8%. But what the scheme stated is that a minimum of 10% by the employer, while minimum of 8% by the employee. So the scheme allows both the employer and the employee, based on their agreement, to make a contribution more than the specified regulations. Any employee may, in addition to the total contribution being made by him and his employer, make voluntary contribution to his retirement savings account. Aside from adding additional percentage to a monthly contribution of your pension, employee can also volunteer by making additional contribution to his or her pension accounts in form of retirement savings plan. Are we together, please? Can we all hear me?
Yes, sir.
All right. Notwithstanding any of the provision of this act, an employer may agree on the payment of additional benefits to the employee upon retirement. Don't forget that this contribution will be entitled to, the employee will be entitled to the contribution after the retiring age. Now, another additional to the contribution is that the employer can make any additional benefits to the employee upon retirement after the consolidated payments to the retirement savings account. So the employer can also make a provision or send an additional benefit to the employee's retirement account upon retirement, or elect to bear the full responsibility of the scheme, provided that in such case, the employer's contribution shall not be less than 20% of the monthly emoluments of the employee. In addition to the rates specified above, employers shall maintain life insurance policy in favor of the employees for a minimum of 3 times the annual total emoluments of the individuals, aside from the 13% contribution from the employer. The employer also has the responsibility to maintain life insurance policy in favor of their employees for a minimum of 3 times the annual total emolument of individual employees. Where the employer failed, refused, or omitted to make payments as and when due, the employer shall make arrangements to effect the payment of claims arising from the death of any staff in its employment during the period. That is under the life insurance policy under the scheme. Exemption from New Pension Reform Act 2014, Section 5, subsection 1. The categories of persons that are exempted from the contributory pension scheme are A, categories of persons mentioned in Section 291 of the Constitution of the Federal Republic of Nigeria, including the members of the armed forces, the intelligence, and secret services of the Federation. They are exempted from the New Pension Reform Act of 2014. An employee who is entitled to retirement benefits under any pension scheme existing before 25th day of June 2004 and has 3 or less than 3 years to retire. That is anyone that has registered under the Pension Reform Act of 2004 as before 25th day of June 2004 and is having less than 3 years to retire. These categories of people will also be exempted from the Pension Reform Act of 2014. Any person who falls within the provision of A and B above shall continue to derive retirement benefits under such existing pension scheme as provided for in the second schedule of this act attached below. That is, they will follow the previous pension Reform Act, not the new Pension Reform Act of 2014, the two categories of people that was mentioned in A and B. Where an officer exempted under B above dies in service or in the course of duty, the Federal Government Pension Transitional Arrangement Directorate and Federal Capital Territory Pension Transition Arrangements Directorate shall cause to be paid, that is, any officer in B that were mentioned in B above should die in duty. The departments that are in charge of pension shall cause to be paid all the entitlements, is next of kin or designated survivors, gratuity and pension to which the officer will have been entitled to as at the date of his death, which will be calculated on the basis of applicable computation under the existing pay-as-you-go pension scheme of the Public Service of the Federation. So before, we're having formula in calculating entitlement to pensioners, unlike the new Pension Reform Act that has made it stipulated to all employees and employers to be making payments into these accounts, which will be paid back to the employer after the retiring age. And there are provision on how these retirements will be paid to the retiring officer up to the age of death. This is a computation of the retirement benefits, the old scheme that has been in place before the Pension Reform Act of 2014. Usually have the year of qualifying service, gratuity as percentage of final pay, pension as percentage of final pay, year of qualifying service, enrollment, gratuity as percentage of total final enrollment. We have pension as percentage of final enrollment. So the qualifying service, before someone can be able to be qualifying for pension, such person will have attained the age of 10 years. That was on the old pension scheme. So starting from 10, the percentage of year of qualifying service, we start from 10, 11, 12, and so on. And the gratuity is based on 100, while pension will be based on 30. And the difference therein to be paid to the pensioner after 1 year, the gratuity will be increasing by 8%, while the pension will be increasing by 22%. So this is the old scheme that has been used before the Pension Reform Act of 2014. Supervision of the retirement benefits of employees exempted from the scheme. Any questions so far? Are we together?
Yeah, together.
All right. Supervision of retirement benefits of employees exempted from the scheme. We have the administration of the retirement benefits of the categories of employees exempted from the scheme under Section 5, subsection 1B of this Act shall be subject to the supervision and regulation of the Commission. Another supervision of the retirement benefits is that in the case of professors covered by the universities and categories of political appointees entitled by virtue of their terms and conditions of employment to retire with full benefits, the Commission shall issue guidelines to regulate the administration of their retirement benefits, provided that any shortfall shall be funded from the budgetary allocations by the employer. So these categories of supervision is that all employees under the university scheme will be paid their the retirement benefits in full. And this will be funded by the federal allocation. So if there are any shortfall, this will be also funded from the budgetary allocations by the employer, so majorly which are federal governments. We have the Accountant General of the Federation and the Federal Capital Territory Treasury, as the case may be, subject to the framework, will develop jointly with the Commission, shall make payments of retirement benefits directly into individual bank accounts of retired person covered under Section 5, Subsection 1B. So this is another supervision of retirement benefits that made it mandatory. So the Accountant General of the Federation to pay in retirement benefits to individuals' bank accounts as at when due. So all this will be the supervision that will be followed to ensure that all employees under the federal capital or under the federal government payee, we have to retain or we have to receive their benefits as at when due, and close monitoring will be made on all the payees. Now, what do we understand by retirement benefits? And who are those that are entitled to these retirement benefits? Payment of retirement benefits. The retirement benefits is the sum of contributions into the retirement accounts, which are expected to be made after the retiring age. How do they make payments on the retirement benefits? Payment of the retirement benefits. A holder of retirement savings accounts shall, upon retirement or attaining the age of 50 years, whichever is later, utilize the balance standing to the credit of his retirement savings for the following benefits. So the first thing, before someone can be able to benefit or to receive payments under the retirement benefits, the person should have attained the retirement age or should have reached 50 years in, should have reached the retirement age or attaining the age of 50 years, whichever is later. And the benefits will follow as programmed monthly or quarterly withdrawals calculated on the basis of an expected lifespan. So these payments will be made on monthly or quarterly withdrawals, and this will be calculated based on expected lifespan of the employee. Withdrawal of a lump sum from the total amount credited to his retirement savings account, provided that the amount left after the lump sum withdrawal shall be sufficient to procure a programmed fund withdrawals or annuity for life in accordance with the extant guidelines issued by the Commission from time to time. These are other payments which allow employees, after attaining the age of retirement, to make a withdrawal of a lump sum from the total amount credited to his retirement savings. And the pension fund administrator will have to guide the pensioner on how to make a lump sum withdrawal. I think after retirement, you can be entitled to 25% of the total savings before the remaining balance will be spread over some other years, which will be prorated on a monthly or quarterly withdrawal basis. Annuity for life for life purchase from a life insurance company licensed by the National Insurance Commission with monthly or quarterly payments. So this is another payment of retirement benefit in form of annuity. We have professors covered by the universities. Miscellaneous provision as amended 2012 shall be according to University Act. So the university are also having their acts on payments of their retirement benefits, and this is covered under their act, which is known as Act 2012 under the University Act. Other categories of employees entitled by virtue of their terms and conditions of employment to retire with full retirement benefits shall still apply. There are organization rules on pensions and gratuity, on pension, on retirement benefits. So this will also cover the terms and conditions on how payments will be made to employee after attaining their retiring age. Death of employee. When an employee dies, what is the treatment? The entitlement under the life insurance policy maintained shall pay to his retirement savings account. That is, any life insurance policy that is being maintained or that has been paid into the employees before the death, such life insurance policy will be transferred to the pensioner retirement savings account. The pension fund administrator shall add the amounts paid from life insurance policy in favor of the beneficiary under a will or the spouse and children of the deceased, or the absence of wife and child to be recorded next of kin or any person designated by him during his lifetime or in the absence of such designation to any person appointed by the probate registry as the administrator of the estate of the deceased in line with the payment of retirement benefit. As we can see, there are alternatives. If the deceased is having a wife or spouse or children, they will be the beneficiary of the retirement benefits of the deceased. If not, the next of kin will be the beneficiary. If not, any other person that has been working alongside with the deceased before the dismissal, or any other person that is being appointed by the probate registry as the administrator of the estates of the deceased, that is any administrator, anybody that is in charge of the estates or the lawyer of the deceased can make an appointment to anyone that can benefit from the retirement benefits in line with the payment of the retirement benefits. Where an employee is missing, there is provision for that as well under the Pension Reform Act of 2014. Where an employee is missing and is not found within a period of 1 year, and it's not found within a period of 1 year from the date it was declared missing, and a board of inquiry set up by the commission concludes that it is reasonable to presume that he has died, normal payment of pension proceeding should be forwarded. That is to say that the employee's entitlements under the life assurance policy maintained shall be paid to his retirement savings account. So when an employee is missing for a period of 1 year, so it will just be assumed that the person is dead. So by that, the policy that cover the life insurance policy will still make it mandated to the insurance to make the payment into his retirement savings account. And after that, under the other conditions still followed by the pension fund administrator will now add the amounts paid from the life insurance policy in favor of the beneficiary, together with his balance in his or her retirement savings accounts, and any of the beneficiary can make a claim on such savings by the employee who is missing over a year. Exemption from taxes, as we have identified as part of what is exempted from tax, which is retirement savings is exempted from tax. Let us look at other exemption from taxes under this pension and gratuity scheme of 2014 reform. Contribution to the scheme are exempted from taxes under this act and shall from part of tax deductible expenses in the computation of tax payable by an employer or employee under the relevant income tax law. So tax is exempted from retirement savings accounts. All interests, dividends, profits, investments, and other income accruable to pension funds assets under this act shall not be taxable. We are still going to discuss on savings on retirement accounts. All these savings that have been made to a pension fund administrator, the pension fund administrator still has the opportunity, he has the power to invest in such pension fund, after which all interest accrued, dividend, profit, investment, and other income that are accruable under the pension fund assets will not be taxable. Any amount payable as a retirement benefit under this act shall not be taxable. That is, when a retiring officer requested for a payment or lump sum payments from the pension fund administrator, so the payments will not be subject to tax. Any voluntary contribution shall be subject to tax at the point of withdrawal, where the withdrawal is made before the end of 5 years from the date of voluntary contribution was made. We still remember that we made some other comments on the contribution, where we noted that 8% will be paid by the employee, while 10% will be paid by the employer. And aside from this minimum requirement, employees or employer can also make a voluntary contribution to that pension fund account. So under the law, this will be charged to tax because they are outside the minimum requirements by the Pension Reform Act. And where the withdrawal is made before the end of 5 years from date of voluntary contribution was made, so tax will be deductible on any other voluntary contribution to that retirement savings accounts. Now let's take a look at retirement savings accounts. We have been talking about pension. And this pension we are making payments to, there will be an account that will be open for pension purpose, and which is known as retirement savings account. This account also operates the same way other bank accounts are operating, just that you can't make easy withdrawal until you attain the age of retirement. Every employee to whom this act applies shall maintain an account Are we together, please?
Yes, sir.
All right, this retirement savings account, every employee to whom this act applies shall maintain an account. And in this act refers to as retirement savings account. In its name, so under this act, you can select any account, any pension fund administrator to take control of your reform of your pension, all your savings, as you are having as much as possible pension fund administrator. We have ARM, we have Sisoni, we have PAL, and so on. So of any choice as the office, as the employee deems fit. The employee shall notify his employer of the pension fund administrator chosen and the identity of the retirement savings account open under A above. So you notify your employer the name of the pension fund administrator you are using, and you provide the accounts that you have opened with the pension fund administrator, so that all your retirement savings can be made directly on a monthly basis to the pension fund administrator. The employer shall deduct as source the monthly contribution of the employee, and not later than 7 working days from the day the employee is paid his salary, remit an amount comprising the employee's contribution under paragraph 1 of the subsection and the employer's contribution of the pension fund custodian specified by the pension fund administrator of the employee. That is, it made it mandatory that after 7 working days, when the employee has been paid his or her salary, such employees' retirement bonus should be paid to the pension fund administrator after 7 working days, minimum of 7 working days. Such should be remitted to the pension fund administrator. Upon receipt of the contribution remitted, we credit the retirement savings account of the employee for whom the employer made the payments. So after the receipt of the retirement savings account of the employee, where an employee fails to open such retirement savings accounts within a period of 6 months after assumption of duty, his employer shall, subject to the guidelines issued by the Commission, request a pension fund administrator to open a nominal retirement savings account for such employee for the remittance of his pension contributions, as it is being mandated by law. The employer must insist the employee to open retirement savings account. In case of any employee that fails to open this account, the employer can make the provision with any pension fund administrator in order to be remitting what is entitled to the employee into his pension account. And this is for the purpose of if there will be any backfire to such. That's why the employer can be on the safer side before the regulatory will come in place. An employer who fails to deduct or remit the contributions within the time stipulated in subsection C, part 2, shall, in addition to making remittance already due, be liable to a penalty to be stipulated by the Commission. And the penalty referred to shall not be less than 2% of the total contribution that remains unpaid for each month or part of each month the default continues, and to the employee's retirement savings account, as the case may be. So when employer were being found guilty of not making remittance into the retirement savings account of their employee, so they will be penalized by making 2% of the total contribution as owings, which will be paid back to the retirement savings account of their employee. Transfer of account from one pension fund administrator to another. Yes. Employee can choose any pension fund administrator. You may be using ARM today and you want to change from ARM to PAL. Then you can transfer all your funds from ARM to PAL, to PAL. So the law mandates it and give a to pension fund and to change any pension fund administrator at any time as the employee deems fit, subject to the guideline issued by the Commission. A holder of a retirement savings account maintained under this act may not, more than one in a year, transfer his account from one pension fund administrator to another. So you cannot do transfer more than one period, one in a year. Transfer from one employment to another. What is the treatment under this Reform Act? Where an employee transfers his employment from one employer to or organization to another, the same retirement savings account shall continue to be maintained by the employee or be transferred subject to section 13 of the Act. So you can still continue with the old pension fund account, retirement savings account with the new employer. Please. Are we there?
Yes.
Okay. Withdrawal from retirement savings account. The conditions which govern withdrawal from the scheme are as follows. Withdrawal is not allowed until the attainment of 50 years of age. Can't make any withdrawal until you attain the age of 50 years. An officer who retired and is less than 50 years on the advice of a suitably qualified physician or properly constituted medical board certifying that the employee is no longer mentally and physically capable of carrying out the function of his office may withdraw. So for any employee that is less than 50 years can make a withdrawal under medical condition. If the officer is retired due to a total or permanent disability, either of mind or body, such person can make a withdrawal. Where the employee retires before the age of 50 years, in accordance with the terms and conditions of his employment, he shall be entitled to make withdrawals. So there are some organizations that can retire employee before the age of 50, and this might be part of the terms and conditions of the employment. So if there is backup to that on the employment letter of any officer that is retiring before the age of 50, such employee can make a withdrawal from the retirement savings account. The medical board or suitably qualified physician, at their request of the employee, be made once in every 2 years to review the fitness of the employee, and where the medical board certifies that he is now mentally and physically capable of carrying out the functions of his office, he may re-enter the scheme upon securing another employment. So this is still under the age of 50. So if any officer that has been retired before the age of 50 and may be re-employed based on medical fitness, can still continue on the retirement savings account and will not have access to withdrawal because of not being able to attain the age of 50. Without prejudice to A above, any employee shall disengage or is disengaged from employment before the age of 50 years and is unable to secure another employment within 4 months of such disengagement, may make withdrawal from his retirement savings account in accordance with the provisions of Section 7, subsection 2 and 3 of the Act. So this, for any employee that is less than 50 years of age, who lost his job or is being disengaged from employment and unable to secure another job within 4 months, can make a withdrawal from the retirement savings account. National Pension Commission. What are their objectives? The principal objective of the Commission, according to the Pension Reform Act of 2014, is to regulate, supervise, and ensure effective administration of the pension matters in Nigeria. They are the police. They are the regulators of pension. Other objectives of the establishment of the National Pension Commission are, they are to ensure that every person who works in the public service of the Federation and private sector receives his retirement benefits as and when due. So they stipulate and they ensure that any person that are under the pension reform scheme are always receiving their benefits when after retirement. They also assist improvident individuals by ensuring that they save in order to cater for their livelihood during old age, and they establish a uniform set of rules, regulations, and standards for the administration and payment of retirement benefits for the public service of the Federation, Federal Capital, and private sector. Powers of the Commission, of the National Pension Commission. The Commission shall have the power to formulate, direct, and oversee all the overall policy on pension matters in Nigeria. They create the rules, they direct, and they oversee all the policy of pension matters in Nigeria. They fix the terms and conditions of service, including remuneration of the employees of the Commission. They request or call for information from any employer or pension administrator or custodian or any other person or institution on matters relating to retirement benefits. For those organizations that are not following the rules, it is also part of their function to move into all organizations that are having more than 15 employees to look into their records if they have been complying with the rules of the Pension Reform Act of 2014. They charge and collect such fees, levies, or penalties as may be specified by the Commission, that is, any offenders to this pension reform power to establish and acquire offices and other premises for the use of the Commission in such location as it may deem necessary for proper performance of its functions. It also has the power to establish standards, rules, and regulations for the management of the pension fund. They look into the regulations of organization on how they have been remitting and how updated are they in terms of the Pension Reform Act. Investigate any pension fund administrator, custodian, or other party involved in the management of pension funds. All the pension administrator, the ARM, the PFE, the PAL, and some other pension fund administrator, they carry out investigation on how they have been managing the funds that belongs to pensioners. They impose administrative sanctions or fines on erring employers or pension fund administrator or custodians. They order the transfer of management or custody of all pension funds or assets being managed by pension fund administrator or held by custodian whose license has been revoked. There are some pension fund administrators that their license may be revoked, maybe due to the 14, the rules and terms and conditions of the Act, or subject to insolvency proceedings to another pension fund administrator or custodian. They also do such other things which, in its opinion, are necessary to ensure the efficient performance of the functions of the Commission. And what are the functions of the Commission? The function of the Pension Commission as stated in Section 23 of the Act are: 1, to regulate and supervise the scheme established under this Act. They regulate and they also supervise. Issue guidelines for the investment of pension funds. They give guidelines to pension fund administrator on how to carry out investments on pension funds in their custody. They approve license. They regulate and supervise pension fund administrators, custodians, and other institutions relating to pension matters, as the Commission may from time to time determine. They establish standards, rules, and guidelines for the management of the pension fund under the Act. They give standards, they give the rules, they give the guidelines and regulation. They also ensure the maintenance of a national data bank of all pension of the scheme. So they promote capacity building and institutional strengthening of pension fund administrators and custodians. They also receive and investigate complaints of impropriety leveled against any pension fund administrator, custodian, or employer, or any of their staff or agents. They carry out investigation. They also receive complaint from any person as against any pension fund administrator, employer, custodian, or any other staff and agents of the pension fund. Composition of the National Pension Commission. Who are the body that form the Pension Fund Commission? The commission comprises a part-time chairman in possession of a university degree or its equivalent and 20 years experience to serve as the chairman. They also have a director general who shall be the chief executive officer of the commission and in position of the appropriate professional skills with not less than 20 years cognate experience. So they will also need a director general that will serve as the chief executive of the commission. 4 full-time commissioners who shall each possesses professional skills and not less than 20 years cognate experience in finance. They will need a commissioner with 20 years cognate experience in finance, investment, accounting, pension management, business administration, or actuarial science. After these 3 personnel, we have a representatives of head of the Civil Service of the Federation, the Federal Ministry of Finance, a representative from the Nigeria Union of Pensioners, the Nigeria Employers Consultative Association, a representative from the Central Bank of Nigeria, Nigerian Labour Congress, Security and Exchange Commission, Trade Union Congress of Nigeria, Nigeria Stock Exchange, and National Insurance Commission. Now, we have been mentioning pension fund administration, administrator, custodian. Let's take a look at who are pension fund administrator and what is their function. Application for a license as pension fund administrator. A person proposing to operate as a pension fund administrator shall apply to the commission for a license in such form and with the payment of such fees as may be prescribed by the commission from time to time in terms of subscription. The commission may, if satisfied that the applicant meets the requirements set out in section 692 or section 60 of the Act, we now issue a license to the applicants to operate as a pension fund administrator, subject to such terms and conditions as the commission may consider expedient and necessary in the circumstances. So after verifying the documents submitted, after looking at the qualification of the person acquiring for the license, and approval will be given to anyone that is requesting for a license to be active as a pension fund administrator. Requirement for the license as a pension fund administrator, these are the requirements. An application for license to operate as a pension fund administrator shall not be granted unless the applicant has the following requirements. It's a limited liability company incorporated under the Companies and Allied Matters Act, whose object is to manage pension fund. That is, the person must have registered his corporation under the CAC and the object of the registration will be to manage pension funds. Has a minimum paid up share capital of such sum as may be prescribed from time to time by the commission. This will also be stated in the certificate of incorporation. Satisfy the commission that it has the professional capacity to manage pension funds and administer retirement benefits. The person who may be a finance holder, a master, a bachelor degree in finance, or accounting or administrative courses. Has never been a manager or administrator of any fund which was mismanaged or has been in distress due to any fault, either fully or partially, of the pension fund administrator or any of its subscribers or directors or officer. Function of the pension fund administrators. Now, after the license has been awarded to the applying officer to serve as a pension fund administrator, what are now the function of the pension fund administrators? Only pension fund administrators licensed by the commission shall manage pension fund. The pension fund administrator shall carry out the following functions: open retirement savings accounts for all employees with personal identity number PIN attached to their pension retirement savings accounts. Invest and manage pension funds and assets. They can invest in pension fund in their custody. Maintain books of accounts on all transactions. Keep proper records. Provide regular information on investment strategy, market returns, and others. They also have the function to provide customer service support to employees, including access to employees' account balance and statements on demand. So if any employee make a request to know the balance on their pension fund accounts, they are to provide the service to the requiring employees. Process the calculations and payment of retirement benefits when the retirement period arrives. So it's the pension fund administrator that will process and they will make calculation on the retirement benefits and carry out their other functions as National Pension Fund Commission may assign from time to time. Prohibited transactions. A pension fund administrator shall not carry out the following: hold any pension fund or assets. Cannot hold any pension fund or assets. You pay, you make payments as at when due or when required. Keep any pension fund or assets with a pension fund custodian in whom the pension fund has any business interest, share, or any relationship whatsoever. So they shall not carry out this function as well. And they shall not engage in any business transaction or trade in any manner with the pension fund administrator as a counterpart or with the subsidiary in relation to pension fund or assets. And lastly, they should not divert or convert pension funds and assets, as well as any income or brokerage, commission arising from the investment of the pension fund or assets, or by any other means. Are we together, please?
Yes, sir.
Prescribed structure of pension fund administration. The following standing committees are required to carry out the fund functions and ensure compliance with the Act. We have the risk management, we have the investment strategy committee to carry out the following function, and these are the structure. What are the roles of the risk management? They are to determine the risk profile of the investing portfolios of the pension fund administrator. So they look at the risk profile. What are the exposure to investing in pension fund accounts? Draw up programs of adjustments in the case of deviations. They determine the level of reserves to cover the risks of the investment portfolio. So they forecast if there will be any perceived risks that will be associated to any investment on pension fund accounts. So they can advise the management on any reserves that can be used to cover the risks of the investment portfolio. They advise the pension fund administrators in maintaining adequate internal control measures and procedures. So they also put in place proper plan, standards to be followed in order not to fall into risks that will be adverse to the pension fund administrator. They also carry out such other functions relating to risk management as the pension board may direct. And the second structure, which is the investment strategy committee, they formulate strategies for complying with the investment guidelines issued by the commission, which commission? The National Pension Commission. So they formulate the strategy to comply with when investing in pension fund. Determine an optimal investment mix consistent with risk profile agreed by the board of the pension fund administration. They evaluate the value of the daily mark-to-market portfolio and make proposals to the board of the pension fund administration. On a periodic basis, the investment strategy committee review the performance of the major securities of the investment portfolio of the pension fund administrator. They carry out a performance review. How has the investment been able to increase the revenue base? And they also carry out such other functions relating to investment strategy as the board may determine from time to time. We have pension fund custodian. Application for license as pension fund custodian. A person proposing to act as a custodian of pension fund shall apply to the commission for a license in such form with the payment of such fees as may be prescribed by the commission from time to time, and the commission may, if satisfied that the applicants meet the requirements set out in section 610(2) below or section 62 of this act, issue a license to the applicant to carry out the function of a pension fund custodian prescribed under section 46 of the act. Now, these are the requirements before license will be issued to those that are requesting to act as a pension fund custodian. Application for license to act as a pension fund custodian shall not be approved by the commission unless such applicants is a limited liability company incorporated under Companies and Allied Matter Act by a licensed financial institution with sole object of keeping custody of pension. So they are also to register under the Corporate Affairs Commission, and their objects, we state that they have the functions of keeping the in their custody of pension funds. Also, they will ask a minimum paid up capital of such sum that may be prescribed by the Commission from time to time, and is wholly owned by a licensed. So the pension fund custodian, we also have to meet up with other requirements that shows that the parent company has issued a guarantee to the full sum and value of the cash flows of pension fund, and the Commission from time to time may determine assets held by the pension fund custodian. Other requirement is that they will undertake to hold the pension fund assets to the exclusive order of the pension fund administration on trust for the respective employees as may be instructed by the pension fund administrator appointed by each employee. The other function is that, the other requirement is that they will has never been a custodian of any fund which was mismanaged or has been in distress due to any default of the pension fund custodian, and lastly, satisfy such additional requirements as may be prescribed from time to time by the Commission. The functions of the pension fund custodian. Section 57 of the Pension Reform Act of 2014. Please, it is not necessary we quote section or subsection for exam purpose. What we just need is what are the functions and their requirements. All these quotes, they are by law, so we don't need to be quoting. But if we can be able to remember all this section, no problem. This section 57 of Pension Reforms Act of 2014 state that pension fund custodian shall carry out the following functions: receive the total contributions remitted by employers on behalf of the pension fund administrators. So they work in hands with pension fund administrator. This is the pension fund administrator that will open a retirement savings account for employee, and this fund will be paid into the employee's account. And it is a function of the pension fund custodian to receive all contributions that is being remitted by employers on behalf of the pension fund administrator. They notify the pension fund administrators within 24 hours of the receipt of contribution from any employer. They hold pension funds and assets in safe custody on trust for the employees and beneficiaries of the retirement savings account. And lastly, they settle transactions and undertake activities related to pension fund. specific obligations of the pension fund custodian. These are the obligations. The pension fund custodian shall maintain all pension fund and assets in its custody to the exclusive order of the relevant pension fund administrator and the commission. Also utilize any pension fund or assets in its custody to meet its own financial obligation to any person whatsoever. And lastly, not to divert or convert pension fund and assets as well as income or brokerage, commission arising from the investment of pension fund or assets or by any other means. Now, penalties and offense. Offense, penalties, and enforcement powers. A person who contravenes any of the provisions of this act commits an offense, and where no penalty is prescribed, shall be liable on conviction to a fine of not less than 250,000 or to a term of not less than 1 year imprisonment, or to both fine and imprisonment. So this will be based on the judgments. So any person that contravenes any provisions of the act and the person has been convicted will be fined for nothing less than 250,000 or a term not less than 1 year imprisonment, or serve both fine and imprisonment. Any person or body who attempt to commit any offense specified in this act commit an offense and is liable on conviction to the same punishment as prescribed for the full offense in the act, offenses and penalties. Without prejudice to Section 174 of the Constitution of the Federal Republic of Nigeria, as amended, a pension fund administrator, pension fund custodian that reimburses or pay for a staff, officer, or director, directly or indirectly, a fine imposed under this act commits an offense and is liable on conviction to a fine of not less than 5 million naira, and also forfeit the amount repaid or reimbursed to staff, officer, or director. Penalties for misappropriation of pension fund. So these are the penalties that will be imposed on anyone that mismanage pension fund. prison term of 10 years plus fine of 3 times the amount misappropriated. Forfeiture of the entire assets and properties or fund with accrued interest or proceed of any unlawful activity under the act in his or her possession. The person will also forfeit the property. The act also criminalizes any reimbursement or payment by PFAs, pension fund administrator, or by pension fund custodian to a staff, officer, or director upon whom a fine has been imposed. So the minimum fine being 5 million naira for anyone that misappropriates pension fund. For pension fund custodian, the minimum fine is 10 million naira upon conviction, where the pension fund custodian fails to hold the funds to the exclusive preserve of the pension fund administrative and the National Pension Commission, PENCOM, or where, if applied, the fund to meet its financial obligations. So the person will be fined for 10 million naira. So in this case, in the case of direct, 5 million naira or 5 years imprisonment or both fine and fee. A pension fund administrator, pension fund custodian, any person or body who refuses to produce any book, account, document, or voucher, give any information, explanation required by the examiner, or with intent to defraud, produces any book, account, document, or voucher, or gives any information or explanation which is false or misleading in any material particular, or supplies information which he knows to be false, or supplies the information recklessly as to its truth or falsify, commit an offense under this act and shall be convicted, be liable to a fine not less than 200,000 or to imprisonment for a term not less than 3 years, or both fine and imprisonment for every false or misleading information given where the offense commits, to a fine not less than 100,000 for every day of the offense. Now, this particular long story is talking about any pension fund administrator or pension fund custodian that gives false information or hide the books of accounts or give information that is misleading will be fined on conviction with 200,000 naira or imprisonment not less than 3 years. Deficiencies of Pension Reform Act 2014. These are the disadvantages or the shortcomings in the Pension Reform Act. The scope and coverage. The scheme applies to employees in both the public and private sector. Mandatory contribution is applicable to organizations in which there are 15 or more employees, previously 5 employees. This effectively reduces the number of employers and employees that are likely to benefit from the scheme, given the low level of contributors under the scheme. So this change is counterproductive. That is, any organization that is less than 15 will not be able to register their employee to benefit from that scheme. So this is one of the deficiencies. Basis of contribution. Contributions are now to be based on monthly emoluments paying the total emolument as defined in the employee's contract of employment, provided it is not less than the total of the employee's basic salary, housing, and transport allowance. So the definition is vague and could be interpreted to part of the base on which the pension rates are applied. So this potentially larger base could well mean that many employers will see an increase of over 100% in their pension contribution, obligations, while employees' net pay will reduce unless their employers choose to increase their salaries to accommodate the additional contribution. So the basis of contribution will not benefit some other employees making use of the new reform of 2014. Rate of contribution. The rate of contributions to be made under the new scheme by both the employer and employee are a minimum of 10% and 8% respectively. That is the new scheme. That's the new reform. 7.5% of the employee's monthly basic housing and transport allowance by both parties under the repealed act. So this will increase the cost of employment and may force many employers to take drastic measures such as rationalization of staff strengths. So here, most employers find it difficult because of the 10% contribution to employees' retirement benefits. So it is disadvantage to the employer being mandated by the Pension Reform Act of 2014, but it will not be benefits to employees that are working in an organization which are less than 15. So these 10% are supposed to be contributed to their pension accounts will not be benefited from such employee. The commencement date. The Pension Reform Act of 2014 was signed into law by the President on 1st of July 2014 with the same date as commencement date. Does not give room for transition arrangements and proper planning by organizations. So government signed this into law on 1st of July, and they made it mandatory to take effect by the date in which it was signed into law, without giving room to any organization to look at how this will be managed and how it's going to take effect in their organization. We have the Pension Transitional Arrangements Directorate. The Pension Transitional Arrangements Directorate is responsible for the pension administration of the defined benefit scheme. What are their functions? The PTAD was established to address the numerous pensioners' complaints that border on issues such as non-payment of monthly pension, short payment of pension and gratuity, removal of name on pension payment voucher, non-payment of harmonized pension arrears, irregular payment of federal pensions, and non-receipt of pension after retirement. So these are their functions. They look into all these matters as relates to pension payments. They are empowered by Section 30, subsection 2A of the amended Pension Reform Act 2004. And it will take over the management of 3 of the offices presently running the old pension scheme. So these are the Civil Service Pension Departments, the Police Pension Office, and the Customs, Immigration, and Prison Pension Office. So these are the team that oversee all the complaints that will be laid by employees on their monthly retirement accounts. Section 42 and Section 44 of Pension Reform Act establish pension transitional arrangement directorates for public service of the Federation and pension transitional arrangement directorates for the Federal Capital Territory, respectively. Now, their functions in details. Functions of the Pension Fund Transitional Arrangement Directorate for public service of the Federation and Federal Capital Territory. 1. Implementation of policies, rules, and regulations relating to pension matters under the defined pension scheme. They ensure accurate payments are made to authentic pensioners under the civil service jurisdiction. Are we together, please?
Yes, sir.
They facilitate the maintenance of the accurate and comprehensive database of pensioners under its jurisdiction, management and maintenance of pensioner records and files. They ensure that all these records were being kept properly. Prepare budgetary estimates for existing pensioners, as well as outstanding liabilities and benefits of pensioners with genuine complaints. And also, they prepare and maintain the monthly payroll of civil service pensioners and issue payments instruction to the Office of the Accountant General of the Federation through the gift means for direct payments to pensioners. Another function of the PTAD is that they respond to pensioner complaints relating but not limited to none, under or overpayment of pensions, gratuities, death benefits, and so on. They carry out monthly payment analysis and payroll review and ascertain deficits in pension payments. They carry out a monthly payroll analysis and prepayment audits of all payment vouchers. They also carry out compliance audits to ensure that government financial rules and regulations are complied with in all financial transactions. They review financial statements, transcripts. They carry out bank reconciliation statements, pensioner statement of claims, and so on. And lastly, safeguarding the assets of the departments. We have micro pension fund. Section 2, subsection 3 of the Pension Reform Act 2014 provides that employees of an organization with less than 3 employees, as well as self-employed person, shall be entitled to participate in contributory pension scheme in accordance with the guidelines issued by the Commission. In accordance with the provision of the Section 2, subsection 3, a micro pension plan, which refers to an arrangement for the provision of the pensions of self-employed and persons operating in the informal sector. So another categories of people that can form under this micro pension plan are those that are under employment, that their employer are having not up to 15 employees. So definition of terms, we have informal sector. The informal sector refers to employees in business entities, organizations, and all persons that are not mandated to implement the contributory pension scheme as provided in Section 2, subsection 1 of the Pension Reform Act. We have self-employed. Self-employed person can also form part of the categories of micro pension plan. The self-employed, a self-employed individual earns his or her income through conducting trade or business for himself or herself. We have micro pension contributor, a person who is registered under the micro pension plan. We have micro pension fund. This is a pool of contributions and all other assets under the micro pension plan. Named beneficiary, an individual, this is an individual or any person who is legally entitled to receive or enjoy any benefits accruable to a deceased or missing micro pension contributor. We have the AFIS, Automated Fingerprint Identification System. This is the biometric identification methodology that uses digital imaging technology to obtain, store, and analyze fingerprint data. We have personal identification number, PIN. The personal identification number is a number issued to an individual upon opening a retirement savings account. Objectives of the guidelines. So these guidelines are set out to achieve the following objective under the micro pension plan. Set eligibility criteria for participation in micro pension plan. Establish the process of registration for prospective micro pension contributors.
If you can hear me, kindly go to the comment section and type 3. Type the number 3. Good evening this evening. If you can hear me loud and clear, this is a quick sound check. I want you to go to the comment section, type number 3.
Define the process of making contributions by micro pension contributors and provide the criteria for managing the micro pension fund. The other objective is that it will outline the modes of assessing benefits under the micro pension plan define the mode of conversion from micro pension plan to mandatory contribution. So when individual is eligible to register under the mandatory contribution plan, so such individual that will have been under the micro pension plan can divert or can transfer his micro pension fund by converting into the mandatory contribution plan and set the minimum ICT requirements for licensed pension fund administrator and custodians. Micro pension contributor. The micro pension contributor shall open a retirement savings account with any pension fund administrator of his or her choice. So we're having pension fund administrators that are also managing micro pension accounts. So any of these pension fund administrators can open a micro pension account to any individual that is willing to maintain such accounts. Make contributions into his or her retirement savings account in accordance with these guidelines. So when such individual has opened the retirement savings account, he can make payments to that contributory account. Request for RSA, retirement savings account statement, from his or her pension fund administrator. Update his or her retirement savings account information on a request. Appoint a next of kin on the micro pension plan. Choose the platform for making contributions. The micro pension contributor can choose the plan So you can appoint a next of kin to operate or to be informed of if there will be any dismissal or or when there is Hello, can you hear me? Hello?
Yes, sir.
Yes.
So you can choose the platform for making contributions and also decide to make contingent withdrawals on the micro pension accounts. You can choose the mode of assessing pension from micro pension plan and demand for adequate customer service as provided in the consumer protection framework issued by the Commission. and the pension fund administrators under the micro pension plan. How did they operate? They opened the RSC for the micro pension contributors. They opened the retirement savings account. They manage micro pension fund and assets in line with the regulation on investment of pension fund assets issued by the Commission. They provide customer service support to micro pension contributors. That is when there are complaints or any other information that may be required by the micro pension contributors, they provide the services to the micro pension contributors. They process, approve, and pay contingent benefits to micro pension contributors. They process and pay retirement benefits to micro pension contributors. They provide secure and suitable plans or platforms for the retirement of contributions, for the remittance of contributions, and payments of benefits under micro pension plan, and they request the Commission to approve other incentives. They render daily and monthly returns on micro pension fund and other periodic returns as may be required by the Commission from time to time as well. And they conduct regular public awareness when there are new introduction or amendments to the plan. They carry out a public awareness, enlightenment, and education of micro pension plans. They issue quarterly retirement savings account statements to the micro pension contributor. So after three months, they give the retirement savings account statements to micro pension contributors. Now, the pension fund custodians under the micro pension contribution, the pension fund custodians shall receive all pension contributions remitted under the micro pension plan from the contributor on behalf of the pension fund administrator. All these pension fund administrators and the custodians, their function is not different, just that their platform are different. The platform of the micro pension fund is different from the normal pension fund administration. So they also receive, their own function is that they receive the contribution that is being remitted under the micro pension plan from the contributor on behalf of the pension fund administrator. They hold micro pension funds and assets in safe custody on trust for micro pension contributors and the beneficiaries of the retirement savings accounts. They settle all transactions relating to the administration and investment of micro pension funds and assets on behalf of the pension fund administrators. That is, any transaction that are involved in investment of micro pension funds, they settle all the transaction. They are in the custody of all the funds that are from the micro contributors. They render returns to the Commission on matters relating to micro pension plan assets being held by it on behalf of any pension fund administrator at such intervals as may be determined from time to time by the Commission. They provide secure and suitable platforms for the remittance of the contributions and payments of benefits under the micro-pension plans to make it easy for the micro-pension contributors. They also carry out other functions on micro pension plan as may be directed by the Commission from time to time. Operational modalities for micro pension plan. These are the modes of plan or of carrying out operation of micro pension fund administration. The foreign person not below 18 years of age with source of income shall be eligible for participation in micro pension plan under Section 2, Subsection 3 of the Pension Reform Act 2014. Self-employed person that belong to a trade, profession, cooperative, or business association can also carry out or can also be part of the micro pension plan. Self-employed persons with a business registration as a company, partnership, or enterprises. So these are other people that can be under the micro pension plan. We have employees operating in the informal sector who work with or without formal written employment contracts. Other self-employed individuals and micro pension contributors shall be residents in Nigeria. Any questions so far? Thank you all for your time. Any question? Hello.
Hi. Just that this particular topic is, I don't know.
I didn't get you.
No, I said this topic is somehow, I don't know. Maybe it's just me, just being tired. Don't know. But I think when I watch it the second time, I should have something to say. I should have something to throw your way.
See, you can't throw anything away from this pension. Are you with me?
Yes, sir.
It's a long topic. It's a long topic because
I can see that.
this is part of the current issues, and that's why this syllabus cover all the entire aspects of the pension. And why do public sector need to monitor this pension? It's because of the suffering that most of the employees have been facing, difficulties that they have been facing in terms of their pension. That's why before now, we've seen a lot of scenario whereby the pension will be paid to a bank, and you will see a pensioner that will be in a bank, they will queue. Some will leave their home as early as 5 o'clock in the morning, and they may leave as late as 6 p.m. With that, they may not have access to their fund. They'll be postponing it to come today, come tomorrow. And these are part of the issues that has been resolved by the Pension Reform Act. So there won't be any need of anybody going into the bank and be queuing. And after making it mandatory, that's why individual, we have a pension fund administrator. And the pension fund administrator, they are to monitor all your remittance from your employer. And as employee as well, if you did not receive any credit in a particular month, you have the right to call your pension fund administrator, ask them, this is a new month, and our salary has been made over 15 days. Why is my pension account not credited up till now? So they will have to tell you if it is from your employer. And if your employer is also delaying, there is penalty for that as well. And part of it that we are seeing now is, if you look at some of these Lebanese companies in our country, go into all these companies, you will find it difficult that they make this as a mandatory. They don't pay pension. All these foreign country coming into the country, they don't pay pension. Even if they have an accountant and the accountant is trying to inform them that these are the payments you need to pay, they will tell you, do you want to still continue with your employment or will you leave the company for them? So these are the issues that have been in place, and the government are looking for ways to stop all the punishments that have been faced. Before now, public sector are not being mandated to be part of this contribution. But based on the new Reform Act, they have made it mandatory to all organizations to put this in place. So if you look at all what we have discussed, none of them is irrelevant. They are all relevant. And the reason why I put everything together, I'm supposed to split this course into two. We're supposed to have it in two tranches. I put it together so that we will not have anything to miss. So by the time we are seeing it in the examination, examiner may ask for the penalty and offense. Examiner may ask for pension fund custodian or ask for pension fund administrator and their function. Examiner may ask questions from the National Pension Commission. What are their functions? Examiner may ask for the in pension now, aside from asking for pension fund administrator or pension fund custodian, what we also need to know is the contribution. What is the rate of contribution? 8% from the employee, while 10% from what? From the employer. And when are you qualified to benefit, to receive your retirement benefits? It is after attaining the age of what? Age of 50. After attaining the age of 50, then you can approach your pension fund administrator that you need part of your savings before your retirement. And there are some people that will not be eligible to withdraw before attaining the age of 50. Who are they? Somebody that are not of that is not retired and it is not attaining the age of 50 will not withdraw. But if anyone retire before the age of 50 based on illness or medical results, such person can withdraw. Anyone that miss or disengage from work and unable to source for new job after 4 months can request for withdrawal from the retirement savings account. So all these are relevant. Any other question?
No, sir. No, sir. Thanks for that.
All right. Please, we can rewatch the video again and again. So today being our last topic, I've started work on the revision question. By God's willing, I'm going to send that. I will try and complete it by Wednesday. I will share it to every one of us. And I'm going to make a provision for a day. If I send the question, what I'm expecting us to do is to start making an attempt on the questions. Then I will find a day. We can use that as much as 4 or 5 hours to solve the most important questions on the practice question that I'm going to send to us, the mock question that I'm going to send to us. Thank you all for your time. Let your revision start today. Exam is less than how many days now? Less than 22 days or 24 days. Thank you all. I want everybody to go into the examination hall and come out with the mark not less than 90%, so that I will come and rejoice with you after your final exam to win the prize with you. So do the same thing to other courses, not only on public sector accounting and finance. By Wednesday, as promised, I will send the practice question to us. Thank you all for your time. Do have a beautiful evening.